A los participantes alrededor del mundo. Les doy la bienvenida a esta edición de Diálogos Flar, titulada La inflación como fenómeno fiscal, evidencia de América Latina, organizada por el Fondo Latinoamericano de Reservas Flar. Este webinar se llevará a cabo en inglés y contará con interpretación simultánea al español disponible en Zoom. Pueden seleccionar el idioma de su preferencia haciendo clic en el botón de interpretación. A continuación, seguiremos en inglés. Hello to all our participants. It is my pleasure to welcome you to our webinar on inflation as a fiscal phenomenon, evidence from Latin America, organized by the Latin American Reserve Fund. This webinar will be conducted in English with simultaneous interpretation into Spanish available on Zoom. You can select your preferred language by clicking on the interpretation button. In recent years, inflation has re-emerged as a key macroeconomic challenge in Latin America. Beyond monetary and external factors, the region's experience highlights the role of fiscal policy, public debt dynamic, and credibility constraints. In this context, the paper, Inflation as a Fiscal Phenomenon, Evidence from Latin America, offers timely empirical evidence on how fiscal imbalances and government budget constraints shape inflation outcomes, with important implications for macroeconomic policy design. The objective of this webinar is to present and discuss the main findings of this paper and to reflect on the relevance for strengthening fiscal sustainability, improving debt management, and reinforcing the credibility of economic policy in the region. During today's session, Professor Francesco Bianchi will present the paper in a 30-minute presentation. This will be followed by a 15-minute discussion by Professor Pablo Guidotti. Following these interventions, we will open the floor for a discussion and a Q&A section based on questions submitted during the registration process. To begin, it is my pleasure to invite Professor Francesco Bianchi to present his paper. As he is widely known to this audience, I will keep his introduction brief. Francesco Bianchi is Professor of Economics at Johns Hopkins University. His research focuses on the interaction between fiscal and monetary policy, expectations, and macroeconomic dynamics, with publications in leading academic journals. His work has been highly influential in advancing our understanding of fiscal determinants of inflation. Thank you very much, Francesco, for accepting our invitation to this webinar.
No, thank you for having me. It's really a pleasure to present in this series of talks. So if that's okay, I'm going to share my slides. I'm also going to try to keep track of my time to make sure people don't complain about Italians and their schedule skills. So first of all, again, thanks for having me. This is a joint work with Robert Berro, Carlos Giraldo, and Yader Giraldo Salazar. And like Andrea kindly already mentioned to you, this paper is very much interested in understanding inflation as a fiscal phenomenon with a focus on Latin American countries. So as you know, at least since the seminal contribution of Sargent and Wallace, economists for a long time have been thinking about inflation as ultimately a fiscal phenomenon. However, because of successes in recent years to bring inflation under control, both in advanced economies, but also in many emerging economies, and because a part of this success has been associated with central bank behavior, somehow the topic became a little bit less interesting to many economists. Now, this is especially true for advanced economies, while, of course, for countries like Latin American countries, this connection between monetary and fiscal policy has always been on the table. What happened with the recent inflation surge is that even in advanced economies, we kind of rediscovered this hidden link between monetary and fiscal policy, and the importance of the two authorities to work together to keep inflation under control. So this paper that I'm going to discuss today relates to some previous work I've done with Robert Berro, in which we look at a cross-section of OECD countries, and we show that you can explain the cross-sectional variation of inflation in the post-pandemic period in a way that is very much related to the amount of spending, rescaled by the size of debt and the duration of outstanding debt. And I'm going to explain why that's the case. So what we do in this paper is to extend that analysis to focus on Flar plus 2 countries, meaning the countries are part of Flar plus 2 additional Latin American countries, to try to understand if the conclusions that are based on OECD countries also apply to these different sample of countries. There is a partial overlap between the two, but it's very limited, and so this makes the analysis interesting. So what I'm going to discuss is that, as in the previous paper, as in my previous work with Robert, we find a strong link between fiscal policy and inflation. So from that point of view, there is very much continuity between the two papers. However, there are some important differences between the results that we got in the original paper and the results that we got in this new paper that I think are going to be interesting for the audience, because they point possibly into some specific characteristic of Latin American countries. And then we're going to broaden the perspective and think about the link between inflation and fiscal policy even beyond the COVID period. Okay, so let me start with some very quick stylized facts about the Flar plus 2 countries. So here you have the time series starting from the post-millennial period for government expenditure minus interest payments, and then government expenditure minus interest payments, but has a fraction of GDP. That would be the third column. In the first row, you have the absolute values of these variables, while in the second row, we normalize these variables to be equal to 1 at the onset of the COVID pandemic. So just to understand a bit better, what is the amount of variation that we get before the pandemic and during the pandemic? So now what you can see, in the interest of time, I'm going to focus on the lower right panel that focuses essentially on to what happens to the level of spending, excluding interest payments with respect to GDP. So as you can tell, there is a significant amount of heterogeneity in the way Latin American countries reacted to the pandemic. Some countries really had a significant increase in spending with respect to the size of their economies, but then you have experiences like Costa Rica. They actually moved in the opposite direction. And I don't need to explain that a possible explanation for why Costa Rica couldn't implement a significant fiscal expansion is because it had recently gone through an episode of partial default. However, the remaining countries, to a large extent, they actually implemented a large fiscal stimulus. So now what we are interested in is to understand if this large fiscal stimulus has any connection with the inflation experience of these countries. So here we have a similar structure for this figure. On the top, you have inflation and debt as a ratio, as a percentage of GDP. And at the bottom, you have the same variables, but rescaled in a way that at the onset of the COVID recession, they are normalized to 1. So again, this allows us to take into account that perhaps some countries have consistently higher inflation than others, and it highlights what happens pre and post-pandemic. So again, what we can see in the pre and post-pandemic, when we look at the period right after the recession, the COVID pandemic, we see large increase in inflation in average across countries. But once again, we see a fair amount of variation. For example, a country like Ecuador experienced very little inflation compared to, for example, Chile. And it's something similar, again, can be seen on the side of the debt to GDP ratio, for which some countries have a significant increase in debt to GDP ratio, while other countries much more modest. Okay, so now we need a conceptual framework to understand the link between inflation and spending, and we're going to build a conceptual framework starting from the budget identity that is at the core of the fiscal theory price level. So on the left-hand side, you have the market value of debt divided by the price level, and on the right-hand side, you have the present discounted value of future primary surpluses. So as I was saying, you can obtain this relation as by solving the government budget constraint forward. So essentially it's an accounting identity. But what we are interested in is to try to understand the way this accounting identity holds in equilibrium once you have a large increase in spending. So in principle, a large increase in spending could be followed by the necessary fiscal adjustments at some point in the future. But if agents don't believe that these fiscal adjustments are going to occur, then something else has to give, and this something else is inflation. Okay? So now to formalize this idea, we can think about the change in the present discounted value of future primary surpluses as the current level of GDP and a series of changes on the future spending to GDP ratio. That would be the second expression in this slide. And we assume that this lasts for n periods. So in our sample, the n periods is 2 years. So it's supposed that the level of spending goes up for 2 years in response to the pandemic. Then on the left-hand side, if there is no a compensating change in taxation at some point in the future, then the way you can achieve this equilibrium, this accounting identity, is through a change in inflation. And in particular, the change in value of debt depends on the future path of inflation over the next capital T periods. And to be specific, it depends on the difference between what agents, what investors thought that the inflation was going to be when debt was issued. That would be this pi star, that think about this as the inflation target that a country had when the debt was issued, and instead the inflation rate that gets realized. So essentially inflation through revaluation effects lowers the value of outstanding debt, and that determines a shift in the left-hand side of the expression that can compensate the drop in the present discounted value of primary surpluses on the right-hand side. So then the change in debt, we show that as an approximation, the change in the value of debt can be approximated by the amount of outstanding debt, the average maturity, and the change in inflation. So in order to understand this relation, let me organize it a bit, for which I have on the left-hand side, I have the change in inflation that is necessary following the fiscal shock. On the right-hand side, I have the size of the fiscal shock. That would be the expression in red. Then I divide everything by the amount of outstanding debt. This would be the expression in green, and the average duration of debt. Now let's try to understand what is happening here. So it's quite intuitive that if you spend more and you don't adjust taxes, and instead you stabilize the budget through inflation, the more you spend, the more inflation you're going to get. So that gives you this direct relation between the left-hand side and the present discounted value of the increase in spending. To understand why the outstanding debt actually lowers the amount of inflation that you need, you can think about this as debt as being the tax base on which inflation acts. If you have a lot of outstanding debt, every single unit of inflation helps you more because it goes to devaluate a larger stock of debt. So this is very similar to increasing a tax rate on a large tax base versus a small tax base. Now, why does the duration of outstanding debt lowers the amount of inflation that you need? Well, because you can spread the amount of inflation over a more prolonged period of time. So if you have long-term bonds, instead of just having a sharp jump in inflation today, you can try to distribute it over a long period of time, and this determines a drop in the market value of long-term bonds, okay? And so everything is equal, you need less inflation. So this is the theoretical implications that we test. Notice that I have a parameter eta in front of this right-hand side. So in principle, if you have a fiscal stimulus that is expected to be followed by fiscal adjustments, eta is going to be 0 and no change in inflation is going to occur. If on the opposite side, you have that the fiscal stimulus is entirely financed through inflation, then eta would be equal to 1. So what we're interested in is in checking whether this coefficient is in fact different from 0, and possibly even what the magnitude of the coefficient is. So in order to make this implementable, what we did in the previous paper, and we do again in this paper with a different set of countries, is to look at two possible specifications. One is a panel regression, in which you regress the inflation in country I at time t, on a country fixed effect that you can think about as the average inflation in that country. the level of spending adjusted by debt and maturity, a series of controls, and expectation, and the residual. You can easily run a similar regression by looking at the change in inflation pre and post pandemic. So the two expressions are going to give you very similar results, especially for countries that have very stable levels of inflation before the pandemic. Okay, so then we bring, as I was saying, we are going to focus on Latin American countries. So this is the sample of countries that we are looking at. So as I was saying, there is a limited overlap with the countries we looked at in the previous paper, meaning that Chile, Colombia, Costa Rica, and Mexico, they are member of the OECD, so they were already part of the previous analysis. But then we have a much richer set of countries when it comes to Latin America, with all the Flar countries, plus Brazil and Chile. So the variables we are interested in ultimately are primary spending, real GDP, because we want to control for the effective size of debt with respect to the size of the economy. Ukraine is a dummy variable that takes into account that perhaps the disruption generated by the Russian aggression of Ukraine might have generated some additional inflation. So we want to control for that episode. But then we also, later on in our analysis, when we extend the analysis to beyond the COVID period, we're also interested in thinking about other possible determinants of inflation in Latin American countries. And so we're going to look at energy indices and non-energy indices. So these are essentially commodity price indices. So here you have some summary statistics. So what is interesting is something that you could already see from the initial stylized facts that I showed to you, that there is a fair amount of variation in the data, both across countries and over time. So for example, just to focus on inflation, the average is 0.05, but then it goes all the way to a maximum of almost 0.2 and to a minimum of essentially 0, slightly negative value. And the same thing is true for the primary spending and the real GDP. That's a known fact that there is a fair amount of volatility in real activity in Latin American countries. Even when we focus on the amount of extra spending that was implemented during the COVID recession, you can see again this very wide range of values that again we could see already from the graphs of the stylized facts, for which, okay, in average, there was a large increase in spending during the pandemic. But then ultimately, there are also countries that went into the opposite direction, like Costa Rica, that I was pointing out in the very beginning, or with much larger fiscal stimulus on the opposite side of the spectrum. Okay, so we're going to run a series of regressions. So the first regression that we are interested in is the one that's motivated by the conceptual framework that I gave you a moment ago, for which we are going to check what happens to inflation pre and post pandemic, and how this is related to these composite government spending variables. So this would be the change in spending rescaled by the size of debt and the maturity of a standing debt. Then we're going to extend, as I was saying, we're going to extend the analysis to go beyond just the pandemic and try to find evidence potentially of a more stable relation between spending and inflation outcomes for this set of countries. Now, the reason why this is interesting is because in the previous paper, we found that there is a very strong relation in the cross-sectional dispersion of spending and inflation only for the post-pandemic period. So in the sense, for OECD countries, typically you do not find a strong relation between the level of spending and inflation outcomes. So we're going to check whether this is the case also for the set of countries we have in this sample. And then we're also going to do this by, in a sense, with a series of robustness checks that also control for many other possible variables that could potentially explain inflation outcomes in Latin America. Notice that in the paper, we actually tried even more controls than the one I'm going to discuss today. These are, in a sense, the ones that turn out to be interesting, but we actually have an even wider set of possible controls. Okay, so let me move to the results. So let me start with the baseline results, and then we are going to dig more into variations of these baseline results. So the first thing we want to establish is that there is no systematic relation between how much countries spent and their outcomes during the pandemic. So in order to do this, we run a very simple regression in which we regress the change in the excess in spending, that will be on the left-hand side, versus the outcomes, the change, essentially the change in real activity during the pandemic for this set of Latin American countries. And you can see the coefficient is not statistically significant. There is a mild negative relation that, if anything, would determine less of a role. If anything, I would say would make our results even more robust, okay, compared to if you're worried about cases of indigeneity. At the same time, we also check that there is no systematic relation between the composite government spending variable that we are interested in, that is our key regressor, and again, outcomes. Okay, so maybe you can, if you have in mind a story in which what happens is that there is something happening to the real economy, the fiscal authority reacts to what happens to the real economy, and then inflation materializes, but ultimately what generating inflation is what happened to the real economy in the first place. Well, that's not happening here because we don't find a systematic relation between the cross-sectional variation of spending and the cross-sectional variation of real activity. Having put these concerns a little bit to rest, we are then interested in our key regression that essentially is a regression of headline inflation on this composite G variable. So what happens to inflation during the pandemic with respect to the cross-sectional variation in spending. And as you can see, we find a large and statistically significant coefficient that is actually very close to 1. In fact, if you were to do a test of whether this coefficient is statistically different from 1, you would find that you cannot reject the null hypothesis. So what that means is that there is a very strong relation between the cross-sectional variation of inflation and the composite government variable. So this is if you do it with the panel regression with country fixed effect, but even if you do it with the, let's say, the alternative version in which you look at the pre and post change in inflation, that would be the last regression here in this slide, you again find a coefficient that is very similar. And what is interesting, if you notice, the intercept here is not statistically significant. So what that means is that not only the cross-sectional variation of inflation can be explained well by the differences in the amount of spending, but also there is not, let's say, a shift there that applies to all countries in the same way. And again, this is encouraging because it would be hard to explain the cross-sectional variation inflation just as a result of the COVID pandemic, in this common shock across all countries. So this, I'm just summarizing the results I just mentioned. I want to emphasize that at least so far, the results seem very much in line with what we find with my previous work with Robert. Interestingly, even the size of the coefficient is very similar. Okay, it's very similar. Even in the paper with Robert, the coefficient eta, this relation between cross-sectional variation in spending and inflation, was around 0.8. So what I'm going to talk about next is instead what turns out to be different with respect to their previous analysis. Okay, and I think that actually hints to some interesting dynamics that apply to Latin American countries. So the first thing we find is that if you focus just on the change in spending without rescaling for the size of outstanding debt and the duration of outstanding debt, so in a sense, if you just look at the size of the fiscal stimulus, you actually find a very strong relation. Now, this is not the case for OECD countries. For OECD countries, to control for these additional dimensions, the size of outstanding debt and duration, is key to get a strong relation between inflation and the fiscal stimulus. So this is already one important difference with respect to the previous work. So this is instead just graphically the regression that I showed you a moment before in a table. So this is instead if you use our composite variables. So what I want to draw your attention to is that the R square of our, let's say, baseline regression is around 37%, while the R square of the regression that does not normalize by depth and duration is actually a little bit higher. So in other words, another way to say this is that the model fits slightly better if you do not normalize by duration and size of outstanding debt. And I'll go back to a possible interpretation of why that's the case. Now, if you redo the analysis as a robustness check by looking at the change in inflation with respect to the shorter period of time before the pandemic, so instead of looking at 10 years before the pandemic, you just look at how inflation changed with respect to the 3 years before the pandemic, you again find very similar results. That again, you get a good relation, both if you control for the size of debt and duration, but you also get a good fit if you do not control for these variables. Okay, so these results basically get confirmed even if you look at core inflation instead of headline inflation. And we actually put this hypothesis to work by testing whether the baseline model that controls for inflation, for duration and size of debt is preferred or not to a restricted version of the model in which one of these variables is restricted to the sample mean. So in other words, take our baseline model and then restrict one of the 3 variables at the time to its sample mean. So what you can see from this table, let's look at column 1. If you look at column 1, you see that the fit of the model deteriorates dramatically. So in other words, if you remove the cross-sectional variation in the size of the fiscal stimulus, the model doesn't work. And this, I think, is pretty intuitive. In a sense, if you don't take into account that some countries spent more than others, then you don't get to explain the cross-sectional variation of inflation. However, if you restrict the debt outstanding or the duration outstanding to be the sample mean for these countries, the fit of the model is slightly better instead of slightly worse, okay? So what this suggests is that for these Latin American countries, the idea that following the fiscal stimulus, if you have a lot of debt or a long maturity, you might be tempted to spread the increase in inflation over a more prolonged period of time, doesn't really work. And our interpretation is that for Latin American countries, it was really important to reestablish credibility right after the spurt of inflation. So in other words, they were way less prone than advanced economies to let inflation remain above target for a prolonged period of time. Okay, so the last part of the paper, once we have established this important difference between emerging economies and advanced economies during the pandemic, is to ask whether something different also applies outside the pandemic. And in order to answer this question, we're going to use dynamic panel regressions. So these are richer models in which instead of just looking at the pandemic period, we also look at inflation dynamics over the whole sample, both cross-sectionally and over time. And what comes out from these regressions, in which on the left-hand side I have inflation outcomes, and on the right-hand side I have a series of controls, is that no matter how many other variables you throw into the regression, you are always going to find that inflation outcomes are very much strongly related to fiscal spending. So here I emphasize the variable in red, that this is the change in primary spending. So why is this important? Well, because it really suggests that if on the one hand, the Latin American countries seem they were more proactive in stabilizing inflation post-pandemic, perhaps the reason why they did that is because they're very much aware of the strong link between fiscal spending and inflation that is a little bit of a curse throughout time, not just during the pandemic. So it's just the other side of the coin that for emerging economies is really, in particular in this case for Flar countries, is really important to maintain credibility with respect to their ability to keep inflation under control and not overly influenced by fiscal spending. Now, even this result is very robust. As I was saying, in the paper, we consider a series of variations. So here, for example, we show that the coefficient on primary spending remains significant even when you look at real GDP as an additional control. In fact, the interesting thing is that real GDP enters with a negative sign. That is, in fact, a little bit counterintuitive from the point of view of an advanced economy, in which we tend to think about inflation as pro-cyclical. So instead here, you really think about some kind of stagflation dynamics, for which the typical inflationary episode, if anything, is associated with a slowdown in real activity. But again, the important thing for our paper is that here, the coefficients on primary spendings always remain positive and statistically significant. And this is true even if we keep adding potential regressors. And I repeat, here we only report the ones that turn out to be important. But you can see that even if we add a change in energy prices or change in non-energy commodity prices, if we control for the Ukraine conflict, you are always going to find that primary spending enters with a positive and statistically significant coefficient when it comes to inflation outcomes. Okay, so I think I'm on track to finish within my 30 minutes. So to summarize, so we adopted the framework developed in Barro Bianchi to study the link between inflation and fiscal expansions in Latin America. Our starting point was the pandemic, but then we went beyond the pandemic by looking at more systematically the relation between fiscal spending and inflation. Now, in the original framework, we found that for OECD countries, it was really important to control for the size of outstanding debt and duration. In a sense, you get a much better fit if you control for the outstanding debt and duration, with the idea that in these countries, more debt is, so to speak, good if you are trying to inflate, because it gives you a larger base to get revenues out of an increase in inflation. And duration is also good because longer duration gives you the ability to smooth the increase in inflation over a prolonged period of time. Clearly, these last two aspects do not apply to Latin American countries. There seems to be a deliberate attempt of bringing inflation under control much faster than what we observed in advanced economies. And our interpretation, and it's a bit speculative, admittedly, is that this has to do with the reputation concerns. That the reason why Latin American countries were a little bit more proactive in increasing rates is because the idea that they can keep inflation above target for, let's say, 5 years without suffering long-term consequences in terms of reputation is just an illusion. While the US, even today, I think people were celebrating because finally inflation is dropped below 3%. Okay, so I think countries with stronger reputation, they might have a little bit more leeway in deviating from systematic inflation targeting. Thank you.
Thank you, Francesco, for this useful interpretation of the structural challenges that inflation poses in Latin America. Clearly, your paper shows that progress in monetary policy has been important, but not sufficient, as persistent fiscal imbalances and credibility constraints continue to play a central role. The message that emerges is clear. Without stronger and more consistent fiscal frameworks, inflation risks remain in the region. Now, let us turn to the comments by our discussant, Pablo Guidotti, who has kindly accepted our invitation to discuss the paper. Professor Pablo Guidotti is widely known to this audience for his distinguished career across academia and public policy sector. He is professor of economics at Torquato Di Tella University and has extensive experience as a policymaker and advisor in Latin America, particularly in areas of fiscal policy and macroeconomic frameworks. Pablo, the floor is yours.
Thank you so much, Andrea, and thank you to Flar for the invitation. And thank you to Francesco for a very nice and clear presentation. So just to summarize the main results of the paper that I'm going to discuss, essentially the model that explains this interaction between temporary government shocks to expenditure and inflation the relation between this and how the stock of public debt and the characteristics of the public debt, especially the maturity structure, affect. That is essentially the core of what the paper is doing. In this paper, there is clearly, when we talk about exceptional shocks like COVID, there is a coordination between Treasury and the central bank in terms of allowing inflation to accommodate the necessary effect to make debt sustainable. So it's a little bit a model in which there is not so much independence, a very strict independence of the central bank. And of course, the implications of the model, as Francesco said, is that there is a positive relation between increases in spending and inflation. Inflation is higher, the higher is the increase in government expenditure, and eventually the theoretical model would imply that inflation would be higher in countries where the initial debt is lower. And here, when we talk about debt, I imagine that we are talking about debt in domestic currency, not all the debt. That is a question for Francesco. And also finally, that the higher duration of the debt would imply a lower increase in inflation, but more persistent over time. So, and this is essentially the results applied to a set of Latin American countries, essentially support this positive relation between inflation and expenditure. And but there is limited evidence about the role of initial debt and the maturity structure of the debt. So while I was reading this paper, I went back and I recalled the work that we did in the early 1990s with Guillermo Calvo. We published a series of papers exactly analyzing the relationship between public debt, the characteristic, whether it was indexed or whether the maturity was long or short, inflation, and the credibility of monetary policy in the face of temporary shocks in primary expenditure. At that time, the term fiscal theory of the price level was not really used, but essentially the term was more in line with the optimal inflation tax literature. And it is important to notice, to have in mind that at that time, the situation for emerging markets and Latin American countries was very different than what it is today. At that time, most countries issued foreign currency debt, mostly in US dollars. Most countries had relatively fixed exchange rate regimes, and many years of low credibility and high inflation. The development of domestic debt markets was certainly a challenge at the time, and most recent experiences with domestic debt had ended in financial crisis and high inflation episodes. So the conventional wisdom for fiscal and monetary policy at that time, I would say that was anchored in, on the one hand, Barrow's tax smoothing model, where temporary shocks should be financed through debt. And on the other hand, the central bank independence literature, which would point to the need for a low and stable inflation over time. Okay? So in this context, we were interested in better understanding how the public debt and its characteristics affected the inflation to generate, the incentives to generate inflation, and how more generally they affected the credibility of monetary policy. So we focused on this most standard type of debt contract with fixed nominal rates and some amortization, normally bullet. And immediately we noticed that in the presence of domestic currency debt of this type, then inflation could be a potentially powerful financing tool by affecting ex post real return on domestic debt. If we consider a distribution of spending shocks, inflation around an expected mean consistent, say, with a target, would make the real return on debt variable, and that would imply an inflation positively correlated with government expenditure. And the presence of domestic currency debt is much more powerful than what was emphasized by the optimal taxation literature focusing simply on money. Okay, so for instance, if you take a country like at that time was Italy with say 100% debt to GDP, suddenly a variation of 1 percentage point around the mean would mean an ability to finance a 1% GDP volatility in government expenditure. So, relatively small inflation would generate a relatively high fiscal effect. And here is where the maturity structure
Pablo, could you open your microphone, please?
As Francesco mentioned, there are two dimensions of the debt as a tax base. First, the size of debt, of course. But if we look at the maturity, it's like extending the tax base on an intertemporal dimension, right? If you compare the difference between a 1-year maturity bond and a 30-year maturity bond, if you have a 1% increase in inflation during 30 years, you reduce the amount of debt, the real value of debt, say by 30%. And if you want to do that on the short-term 1-year bond, you need to have a 30% inflation in that year, which may be extremely costly. So in this case, we said, what happens if a country has full credibility? Namely, it is able to commit to an average inflation that is consistent with the target. And that is what is going to be embedded or included in nominal interest rates. And around this mean, there is flexibility of monetary policy, which will allow the financing of spending shocks. In this case, where there is full credibility, and you ask, what is the optimal policy? Interestingly, the optimal policy is to have debt very large or the maturity very long. And it doesn't necessarily imply gross debt or net debt. Simply, you can have debt and then you can have foreign currency assets. Okay, so it's not necessarily a recommendation for large debt. But in the end, or in the limit, what this solution is exactly the contrary of what we said was the conventional wisdom, because you would finance temporary shocks only through these small changes in inflation around the mean, and not use debt as in the tax smoothing model. Okay, so that was one result that we immediately found. But of course, the assumption of full credibility is not realistic. So there is where we introduce the timing consistency and the fact that once you have debt as a sitting duck, the government will have an incentive to use inflation above what is this flexibility element, and you will run into high expected inflation, which then will bring high nominal interest rates in the economy. So once you introduce this lack of credibility, then there is this trade-off between the flexibility that you want to have to monetary policy and the need to control for the incentives to produce inflation, the credibility aspect. And the conclusion of this analysis is that, first of all, In this context, the tools that the government has to enhance credibility are essentially issuing foreign debt contracts or index contract, because they cannot be reduced in real values by inflation. But also we find that shorter maturities are essentially similar in terms of effect to having indexed of foreign currency debt. So what this analysis helped us understand, why, for instance, there is a difference between advanced economies and emerging markets with low credibility, why advanced economies never liked to issue debt in a different currency. At some point, Italy was issuing debt in ECUs, which is very much similar to what I was describing, while most emerging markets were issuing in foreign debt and shorter maturities. This does not need to imply that authorities in countries have make all of this complicated analysis, okay? It's simply the reaction that since you are not credible, you face very high interest rates in long-term debt. So you essentially decide to issue shorter-term debt, okay? So, so I think that when now we go to the results of the paper and today's situation, what is the big difference? Well, first of all, most EMs and most Latin American countries have now adopted exchange rate flexibility, but have inflation targeting a policy regime that have gained a lot of credibility through time. Okay, so now you have, different from the initial part of globalization, now central banks are quite credible. Also, domestic debt markets have been developed, and given the credibility, interest rates on domestic debt are reasonable in most countries. But we cannot avoid thinking that domestic debt always has this capacity of generating incentives to be used. Okay, so when we look at the results of the paper, in which in an exceptional situation such as COVID, we find, the authors find, this positive relation with between government expenditure and inflation, I think that is necessarily not surprising. And one question that one should make is it really a curse or is a policy decision? Okay, the standard, the conventional wisdom that I was describing before, which applied also to advanced economies, well, really advanced economies did something different, both in the global financial crisis and in COVID. If we look at the Fed had made a huge monetary expansion during the global financial crisis, and in COVID, it multiplied by 3 times that monetary expansion and fiscal expansion. So we shouldn't be surprised that eventually there was an increase in inflation in the world as a whole. Okay, and the question is, was that an optimal response or not? If it was an optimal response, then the question is, what are the implications for policy design? Should central banks and treasuries eventually identify situations in which there needs to be a coordination to use temporarily inflation as a financing tool, given the outstanding debt and the characteristics of the debt, and probably if we have countries with credible institutions, I think that the recommendation of having longer maturities is actually a good recommendation, because it will make these situations much more manageable. But I think that there is really a profound issue to be analyzed. You know, the policy recommendations of the paper are very reasonable in terms of promoting fiscal rules, longer maturities, and effective coordination between central banks and treasuries. I would stress that at least for LATAM and emerging markets, a critical element to the credibility and sustainability of economic policy has always been adequate external liquidity. And in fact, that is when you analyze the relations between fundamentals and risk spreads in emerging markets, possibly the two elements that matter the most are variables like reserves to short-term debt and institutional strength variables, you know, and you have different ones. One is the index of economic freedom, but you know, there are several. And also it's important in terms of the fiscal variables, the debt, okay? Much less I find the deficit levels, okay? So let me finish just with you know, before the specific, a couple of specific questions. I think it's also interesting the fact that the authors find this relationship between inflation and expenditure after COVID. So it goes to the question whether this is a relationship that only happens in exceptional times or not. You know, I think it's part of, you know, the model that I discussed, the one with Guillermo. We really, you know, we're not distinguishing between exceptional and was essentially optimal policy design. So it is something that should be tested. What is really, if this relationship is something that occurs over time under normal situations, which appears to be the case in OECD, no, in the work that you have done. So I have three specific questions. One, if you have thought of introducing foreign currency, the share of foreign currency debt in the empirical test. I didn't see that. The second one is, was ever Argentina in the sample, and why not? Or because given that you have two non-Flar countries, I think is then. One observation is that in the countries in the sample, not all have the same market access to the international capital market. So is this a factor to be considered in the empirical analysis? Because, you know, if a country lacks market access, then it may have to rely more on inflation. And also, this may imply that it has a lower initial debt, but maybe the characteristics are affected by, you know, the situation of Bolivia, Ecuador, which are totally different than you know, Chile, Paraguay, Peru. No, so these are my comments.
Thanks a lot, Paulus. I think I can just briefly answer, no, Andrea, and then so this was an excellent discussion. So let me start from the questions. So we In the previous paper, we worked quite a lot in checking whether the foreign currency share or the index share was important, and we couldn't find anything. Now, I believe we tried at some point even here, but we didn't do it systematically. So it's worth going back and do it more systematically. In fact, in the paper, we mentioned that one possible reason why the size of outstanding debt doesn't work so well is because perhaps in these countries, the share that is foreign denominated is larger. So that's a great point. So on Argentina, it was never really part of the sample. And the reason is not because we don't like Argentina. I mean, Argentina is half Italian, so it has a special place in my heart. It's just because ideally, you would want to start from a situation in which before the shock, we were around a steady state. Now, to be honest, this is already a little bit of a stretch, even for some other of these countries that we have in the sample. It's just Argentina is really extreme compared to even these other countries. But that's the reason why it's not part of the analysis. Of course, we know that fiscal policy plays a key role in Argentina, and they are the concepts of credibility that you brought to our attention is even more prominent. And absolutely, yes, I think to think about why some countries have lower debt, how that's related to maybe their inability to access international markets, and how that might actually correlate with other factors that might affect the results. That's also important. So in this sense, the OECD countries, I think they were a good case study because they were way more homogeneous. And, you know, I'm trying to, with some co-authors at the Fed, we're really trying to think a little bit more about this transition between, you know, the old style emerging economy versus, I think many countries, I feel like, graduated. And now they have dynamics are way more similar to to advanced economies. So that's why for some OECD countries, there are also Latin American countries, this seems to work very well, for others less. And so what we would like to understand is the transition. What you brought up of your previous work with Calvo, I think is already many of the things we were thinking about. So I think we should go back and check the work you have done. I think at some point I was reading a lot of your work, but this was graduate school, and unfortunately was some years ago. So it was when I was taking international macro in graduate school. You mentioned a lot of other very relevant points. So first of all, I think you had this very nice line that we didn't call it the fiscal theory price level. Absolutely. For us, the fiscal theory price level is just a simple conceptual framework to kick off the analysis. But you can think about Lucas Stokey and how following a military conflict, in fact, might be optimal and justifiable to inflate. And you touch another very key point that I try to always mention during my seminars, that with the benefit of hindsight, it's really clear that we went a bit too far, maybe with fiscal stimulus and inflation. But when we think of where we were during the pandemic, and we think how asymmetric the risk was, it's unthinkable to imagine a situation in which the government gives transfers, increases spending, and the central bank hikes interest rates. The risk of a double dip recession, financial crisis was huge. So yes, I mean, what we have learned, maybe we went a bit too far, but was that close to optimal, at least qualitatively? I believe so. And in fact, when at some point I used this word curse, I was not referring to the policy prescriptions during COVID. That I agree with you that maybe that was the only way out with interest rates at the zero lower bound and this and that. I was referring that that's, in a sense, something has been hunting many of these countries for a while, how you create fiscal credibility. And I think what they did, they triggered fiscal inflation, but then they were also very quick in bringing the genie inside the lamp, exactly to avoid giving the perception to international markets, oh, we're back to the 70s or the 80s. But yeah, again, I basically agree with everything you said. So thanks for taking the time to read the paper. I'll follow up maybe to get some couple of references from you.
Very good. Thank you.
Great. Thank you both. In particular, thank you, Pablo, for your thoughtful discussion and questions of the paper, drawing, of course, on your experience as a policymaker and advisor to economic authorities in the region. Let us now move to the Q&A segment. Francesco, let me begin with you with a very broader question. Based on your results, what lessons should Latin American countries take from the post-pandemic fiscal response to avoid repeated inflationary episodes in the future?
No, that's a very good question. So this connects a little bit to what we were just discussing with Pablo. No? So there is an element of the current inflation surge that suggests that perhaps there was the only way out of a very dire situation, in the sense you have a pandemic that hits when most countries around the world are fighting low inflation, interest rates at the zero lower bound. You might say, well, that doesn't really apply to Latin America, but what applies to the US and to more advanced markets indirectly also affects the rest of the world. So this was a little bit of a coordinated response to a very bad shock, not just within countries, in the sense it was not just coordination between the monetary and the fiscal authority, but I would say in an unprecedented way, the IMF itself was way more open to, we need to be bold and we need to spend and we need to dig ourselves out of the recession. So I think what I would say Latin American countries have learned is that, this is a very powerful mechanism, that if you, the bolder you are, the more inflation you get. So you need to be careful what you wish for. At the same time, I think it's fair to say that they were quick in reverting policy once the emergency was over. So I think that was a good lesson in terms of, again, going back to what Pablo was saying, that ideally you would want coordination between monetary and fiscal policy during exceptional circumstances. The problem is that how do you avoid the policymakers cry wolf every time? And they keep saying, this is an emergency, this is an emergency, this is an emergency, and we need to always spend more. So I think the lesson is, yes, a little bit of fiscal inflation can get you out of trouble. At the same time, there is a history that you need to be aware of. And so as soon as the emergency is over, you need to be very quick and reassuring your own citizens and financial markets that you are committed to a long-term fiscal sustainability, long-term price stability. And that can be done only with some decisive change occurs as soon as the crisis is over.
Thank you, Francesco. Given the limited time, let me follow up with a related question. Based on your findings, what matters most for anchoring inflation expectations in Latin America? Maybe expenditure rules, debt ceilings, or stronger institutions?
Excellent question too. So yes, so I think clearly what we learn from this work, previous work by others, is that a sustainable fiscal path is the first thing you need. And then I would say strong institutions, meaning an independent central bank. But I want to emphasize that independent central bank with no clear fiscal backing doesn't go very far. Because the markets, if not citizens, markets definitely are forward-looking, and they're going to do the math. And if they see that you are, you have institutions that in principle are independent, but that your fiscal trajectory eventually will bring you to a conflict between the two authorities, they're going to figure it out ahead of time. So to me, it's sometimes I joke that the best way for fiscal policy is the Nike logo, just do it. Meaning just keep your fiscal situation under control, and then the central bank will be able to deliver on stable prices.
Thank you. I will now turn to a couple of questions for Pablo. The first one is the following. Considering the main messages of the paper and today's discussion, what do you see as the main risks, opportunities, and challenges facing Latin America?
Yes, I think that the last answer that Francesco gave you is very important. I think that certainly countries in Latin America are in different positions, but many countries have weak fiscal situations. So the credibility of the fiscal framework is very important. Maybe the extreme case of Argentina shows the path. Argentina was so uncredible in terms of continuous financial crisis, that the only anchor that the system could have, it was a fiscal anchor. And the government decided to bring the fiscal balance to equilibrium. And I think that that is generating also in the region more consciousness about the importance of fiscal discipline. And the interesting thing, which is totally different than what was analyzed in the inflation stabilization literature, is that once you achieve fiscal equilibrium, and that equilibrium becomes credible, then, whatever you do on the monetary side, even if you do some mistakes, they can be corrected. They are much less determinant than the opposite, which typically countries try to stabilize the inflation rate, but their fiscal is in disorder. So I think that the emphasis in fiscal adjustment and fiscal sustainability, many countries within the sample that is in the paper have debt to GDP ratios above 60%, and some have also very high deficits. I think that those numbers, which today seem not that large because you have advanced economies in the 100s, okay? These are very large numbers for countries that do not have an unlimited access to capital markets. So I think that that is, for me, is the main challenge. And of course, fiscal rules help a lot, but also the importance is that the political environment understands the issue of fiscal sustainability.
Thank you, Pablo. Let me follow up with a second question. Why has it been so difficult for the region to sustain fiscal discipline over time, even after episodes of high inflation or macroeconomic crisis?
Well, I think that in part is the weakness of the political environment. I think that Latin America suffered in many countries of populism, and that I think that was one of the main reasons. Also, we could say that at least several years ago, well, as part of the emerging market world, there was many external shocks, and the economies were less prepared to deal with these shocks. I think that today many countries have learned from the past and have strengthened their resilience to shocks. However, still the weakness of fiscal accounts, the need to redistribute wealth and so on. These are all parts of the political discourse that do not see fiscal discipline as a primary objective of governments. I think that currently, I think that there seems to be, at least in the region, many elections which are showing that populations are starting to understand that this is important, and hopefully this will continue to strengthen the policy frameworks of in the region. Also, I think that this is actually a good moment for emerging markets. I think that after 3 years of outflows, this is the first year. Actually, last year was already there was a recovery of inflows, capital inflows to the region. in this year, the inflows have accelerated to record levels. January has been particularly strong. So I think that this is a moment in which countries should take the opportunity to strengthen their policy frameworks, before we end up in some other global problem.
Thank you, Pablo. Before we conclude, there's one final question I would like to pose both of you. The question is, if you have to give one concrete recommendation to policymakers in Latin America today, politically difficult but macroeconomically essential, what would it be to prevent fiscal dominance from re-emerging as a source of inflation? Let me begin with Francesco, please.
Thanks. Implicitly, I think we talked about this. I think the key advice is that, I mean, apart from all the rhetoric and all things that can be said, I mean, keeping fiscal variables in check, keeping a reasonable amount of debt and that can be sustained following an adverse shock is key. Then, of course, fiscal rules, I think, can help in delivering on that goal, I think almost mechanically. And I think to some extent, I think what Pablo was saying, also Argentina showed that it's possible. It might not be easy. It takes a little bit of understanding of what the trade-offs are. But yeah, I think more than insisting on one particular level of debt or one particular type of fiscal rule, I think to be aware of what the long-term trade-offs are, and to be aware that you need to be prepared to absorb an adverse event. So your debt cannot already be at the maximum possible level, because that's always going to jump up after a recession. I think that's the most important thing.
Francesco. Pablo, could you now share your perspective, please?
Yes, I agree with Francesco. I would say that countries should develop a clear view regarding what is the amount of debt it is sustainable for them, and what is in view of the liquidity requirements, which are related to the maturity structure of their debt. I think that looking at what happens in advanced economies in terms of these variables is not helpful at this moment. I think that advanced economies are on an unsustainable level, most of them. However, they do not face an imminent crisis. In the case of emerging markets, a crisis can be imminent. So I think that levels of 60% or more of debt are extremely high once you take into account the liquidity considerations too.
Thank you very much, Francesco and Pablo. Unfortunately, we have reached the end of our session. We are grateful for your excellent contributions and for the insightful discussion around this timely and important paper. Today's discussion makes clear that lasting macroeconomic stability cannot rely on monetary policy alone, but requires credible and consistent fiscal frameworks that support it. Thank you very much to our audience for joining us today, and we look forward to welcoming you to a future edition of Flar Talks.
Thank you for having us.
Thank you.
Thank you.